Real estate crowdfunding lets you invest in property projects with smaller amounts of money, making real estate more accessible. It can offer good returns and portfolio diversification without the hassles of being a landlord. But like any investment, it comes with risks like less control, liquidity issues, and platform reliability. Whether it's worth it depends on your financial goals, risk tolerance, and how well you research the opportunities. Interested in a deeper dive on the pros and cons? Today we will talk about, is real estate crowdfunding worth it? So before we start, make sure to hit the like button and subscribe to my channel. 1. Understanding real estate crowdfunding. Real estate crowdfunding is a modern investment method where multiple investors pool funds via online platforms to invest in real estate projects. Unlike traditional real estate investing, crowdfunding lowers the capital barrier, allowing individuals to participate in large-scale residential, commercial, or development properties with relatively small amounts, sometimes as little as $500. This democratization opens real estate investment to those who previously couldn't afford direct ownership or were limited to REITs. The projects may include rental properties, fix-and-flip deals, or new developments. Investors earn returns from rental income, interest, or property appreciation. The platform manages pooling, legalities, and distributions, simplifying the process. However, this convenience comes with unique risks and considerations, including illiquidity and platform reliability, which must be carefully evaluated to determine if this investment suits your financial goals. 2. Advantages of real estate crowdfunding. One of the primary benefits of real estate crowdfunding is accessibility. It enables investors with limited capital to enter the real estate market without purchasing entire properties. This lowers the financial threshold and broadens participation. Crowdfunding also offers diversification opportunities by allowing investment across different property types, geographic locations, and risk profiles. It provides a way to earn passive income from rental yields or interest payments, often with relatively predictable cash flow depending on the deal structure. Many platforms also provide professional management, relieving investors from landlord duties or property maintenance. Additionally, real estate historically provides a hedge against inflation and potential capital appreciation, making crowdfunding an appealing alternative to stocks or bonds for portfolio diversification. 3. Risks involved in real estate crowdfunding. Despite its appeal, real estate crowdfunding carries several risks. Illiquidity is a significant concern, as investments are typically locked for years, with limited secondary market options to sell early. Platform risk is another factor. Some platforms lack transparency or might underperform, and there is the chance of fraud or mismanagement. Real estate market risk also exists. Economic downturns, changing interest rates, or local market shifts can impact property values and returns. Fees charged by platforms, including management and performance fees, may erode profits. Additionally, unlike direct ownership, investors have limited control over property management or sale decisions, relying heavily on the platform and developers' competence and honesty. 4. Comparing crowdfunding to traditional real estate investing. Traditional real estate investing involves buying and managing physical properties, requiring substantial capital, time, and effort. Investors bear direct responsibility for maintenance, tenant relations, and financing. In contrast, crowdfunding provides a hands-off approach with lower capital requirements but less control. Traditional ownership offers potential tax benefits like depreciation and mortgage interest deductions, which may not fully translate through crowdfunding structures. On the other hand, crowdfunding offers easier diversification by investing smaller amounts across many projects, reducing the risk of a single property dragging down your portfolio. While traditional investing may yield higher returns for experienced investors, crowdfunding can be a suitable entry point or complementary strategy, especially for passive investors seeking real estate exposure without operational headaches. 5. Types of real estate crowdfunding deals. Real estate crowdfunding projects generally fall into two categories: debt and equity investments. Debt investments involve lending money to developers or property owners, with returns generated from interest payments. These tend to be lower risk and provide regular income but offer limited upsides since returns are capped. Equity investments represent ownership shares in the property or project, entitling investors to rental income and potential profits from appreciation or sale. Equity deals usually carry higher risk but also offer greater reward potential. Some platforms offer hybrid deals combining elements of both. Understanding the deal structure, projected timelines, and exit strategies is vital before investing, as these factors influence liquidity, risk, and expected returns. 6. Due diligence in choosing platforms. Performing thorough due diligence is critical to successful real estate crowdfunding investments. Evaluate the platform's track record, transparency, fees, and investor protections. Check how thoroughly projects are vetted and the quality of information provided to investors. Review the experience and reputation of the developers and management teams behind each project. Understand the legal structure of investments and associated rights, such as voting power or access to financial reports. Look for platforms regulated by relevant authorities, which adds credibility. Also, assess platform fees, minimum investments, and historical returns. Reading user reviews and third-party analyses can offer insights into reliability and customer service. A cautious, informed approach minimizes risk and helps align your investment choices with your financial goals. 7. Tax implications and legal considerations. Investing in real estate crowdfunding has specific tax and legal implications that vary by jurisdiction. Income from crowdfunding, whether interest, dividends, or capital gains, may be taxable, and you might receive K-1 or 1099 forms depending on the investment structure. Unlike owning physical property, you typically don't get direct deductions, such as depreciation, though some platforms may pass these benefits through certain structures. Capital gains taxes may apply upon sale or liquidation. Additionally, crowdfunding investments are often considered illiquid private placements, meaning they may have restrictions on resale and require you to qualify as an accredited investor on some platforms. Understanding these factors and consulting a tax professional helps you plan appropriately and avoid surprises. 8. Is real estate crowdfunding worth it? Real estate crowdfunding can be worth it for investors seeking diversified real estate exposure with lower capital requirements and a passive investment approach. It provides access to opportunities traditionally reserved for wealthy individuals or institutional investors. However, it is not without risks. Illiquidity, platform reliability, fees, and market downturns can impact returns. The key to making it worthwhile is thorough research, understanding the investment structure, and aligning investments with your overall financial goals and risk tolerance. It should be viewed as one component of a diversified portfolio, rather than a standalone strategy. For those comfortable with these factors, real estate crowdfunding offers a compelling way to grow wealth and generate passive income toward financial freedom. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.